Good morning, everybody. I'd like to call this meeting of the FDIC Board to order. We need a sunshine motion. Would someone like to make a sunshine motion?
So moved.
Thank you. And a second?
Second.
Thank you very much. All in favor, please say aye.
Aye.
The motion is adopted. We have several items on the summary agenda. Are there any questions or comments on the summary agenda? If none, I may have a motion to approve the matters and accept the reports on the summary agenda.
So moved.
And a second?
Second.
Thank you. All in favor, please say aye.
Aye.
Aye. Thank you very much. The motion is adopted. We have 3 items on the discussion agenda this morning. The first item is a formal rule on assessments, revised deposit insurance assessment rates. Michael Spencer, Ashley Mahillick, Sheikha Kapoor, and Ryan McCarthy will present the case. Mike, you want to proceed? Oh, Ashley's taking. Okay.
Good morning, Acting Chairman Grunberg and members of the board. Today, we are providing for your consideration a final rule to increase initial deposit insurance assessment rate schedules by 2 basis points. The final rule is intended to achieve 2 complementary policy objectives. Most immediately, the rule is intended to restore the reserve ratio to 1.35% by the statutory deadline of September 30th, 2028. Additionally, the rule supports growth in the Deposit Insurance Fund, or DIF, in progressing toward the long-term fund management goal of a 2% designated reserve ratio, which has been reaffirmed by the board on an annual basis since 2011. Accelerating the timeline to meet these objectives would reduce the likelihood that the FDIC would need to consider a procyclical assessment rate increase when banking and economic conditions may be less favorable. It would also increase the likelihood that the DIF will remain positive through potential future periods of significant losses due to bank failures. As of June 30th, 2020, the reserve ratio fell below the statutory minimum and stood at 1.30%, due solely to extraordinary growth in insured deposits in the first half of 2020. On September 15th, 2020, the board adopted a restoration plan to restore the reserve ratio to the statutory minimum of 1.35% within the statutory 8-year period ending on September 30th, 2028. The restoration plan maintained the assessment rate schedule in place at the time and required staff to update analysis and projections for the DIF balance and reserve ratio at least semi-annually. As of the last semi-annual update in June 2022, the banking industry continued to report strong insured deposit growth, outpacing growth in the DIF. Projections of the reserve ratio under different scenarios indicated that the reserve ratio was at risk of not reaching 1.35% by the statutory deadline. Consequently, the board amended the restoration plan to incorporate a 2 basis point increase in assessment rate schedules for all insured depository institutions and approved a notice of proposed rulemaking to implement this increase. The FDIC received 171 comments on the proposed rule. Staff carefully considered those comments in developing the final rule before the board today. Staff also updated projections and analysis of the statutory factors for the board's consideration using the latest available data as of June 30th, 2022. One of the areas of focus in the comments was the assumptions and analysis of insured deposit growth. While insured deposit growth has shown some signs of normalizing, aggregate insured deposit balances remain elevated relative to pre-pandemic levels. Insured deposits declined in the second quarter, but such a decline is not unusual, as insured deposits have declined in the second quarter in 6 out of the last 9 years. Despite this decline, year-over-year insured deposit growth for the year ending June 30th, 2022 remains strong at 4.3%. This annual growth rate is higher than either of the insured deposit growth rates assumed in the analysis underlying the final rule. While it is possible that insured deposit growth may slow in the future, that is far from certain and difficult to predict given the many factors that affect insured deposit growth. Commenters also expressed concern about the assumptions around investment income. Growth in the DIF has been limited by a prolonged period of low investment returns and recently by unrealized losses on available for sale securities. While we agree that a higher interest rate environment will benefit the growth of the DIF, the timing is highly uncertain. Our longer-term projections already assume positive net investment contributions after the reserve ratio reaches 1.35%. Based on updated data, staff continue to project that the reserve ratio is at risk of not reaching the statutory minimum of 1.35% by September 30th, 2028, absent an increase in assessment rates. In the 8 quarters during which the restoration plan has been in place, maintaining the rate schedules in place when established, the reserve ratio increased in only 2 of those quarters. In fact, the reserve ratio regressed over that period from 1.30% to 1.26% as of June 30th, 2022. Consequently, staff recommend that the board approve this final rule, which adopts the proposal without change. In addition to improving the likelihood that the reserve ratio reaches the statutory minimum of 1.35% reasonably promptly and by the statutory deadline, the increase in assessment rate schedules will support growth in the DIF in progressing toward the long-term fund management goal of a 2% designated reserve ratio. Therefore, the new assessment rate schedules will remain in effect unless and until the reserve ratio meets or exceeds 2% absent further board action. Progressively lower assessment rate schedules will become effective when the reserve ratio exceeds 2% and 2.5%. Under the final rule, the FDIC board will retain the flexibility to adjust total base assessment rates by up to 2 basis points without further notice and comment. Maintaining the ability to adjust rates within limits without notice and comment will allow the FDIC board to act expeditiously in the face of rapidly changing conditions. In developing the recommendation, staff updated their projections for the fund balance and reserve ratio using 2 scenarios that assume different levels of insured deposit growth and average assessment rates to project when the reserve ratio would reach, first, the statutory minimum of 1.35%, and additionally, the long-term goal of a 2% designated reserve ratio. Staff view both scenarios as reasonable based on current and historical data. Under the first scenario, which assumes annual insured deposit growth of 4% and an average annual assessment rate of 3.5 basis points, staff project that the reserve ratio would reach the statutory minimum of 1.35% in the second quarter of 2034, well after the statutory deadline of 2028. Under the second scenario, staff assumed annual insured deposit growth of 3.5% and an average annual assessment rate of 4 basis points. In this more favorable scenario, staff project that the reserve ratio would not reach the statutory minimum of 1.35% until the fourth quarter of 2026, providing little flexibility to prevent a larger pro-cyclical assessment rate increase in the event there is an industry downturn between now and then. Importantly, the insured deposit growth rate assumed in each of these scenarios is below the current annual growth rate of 4.3% for the year ending June 30th, 2022, as I mentioned earlier. Furthermore, additional uncertain factors could materialize between now and September 30th, 2028, and would result in a further decline in the DIF and the reserve ratio. Future economic banking conditions could be challenged by high inflation, rising interest rates, slowing economic growth, and geopolitical uncertainty. Given these uncertainties, staff projected the DIF balance and associated reserve ratio under each scenario, applying an increase in average assessment rates beginning in the first assessment period of 2023. The analysis demonstrated that a modest increase in assessment rates would have a powerful impact and meaningfully accelerate the timeline to reach a 1.35% reserve ratio. For example, staff projected that a 2 basis point assessment rates would result in the reserve ratio reaching the statutory minimum approximately 2 years from now under both scenarios. Such an increase improves the likelihood that the reserve ratio will reach the statutory minimum ahead of the deadline, even in the face of the uncertainty that lies ahead. Staff also estimated the impact the final rule would have on bank capital and earnings. This analysis concluded that an annual increase of 2 basis points in assessment rate schedules would reduce Tier 1 capital by an estimated 0.1% and would reduce annual income by an average of 1.2%. The banking industry continues to report favorable credit quality, earnings, and capital levels, and remained resilient through the second quarter of 2022, despite the extraordinary challenges of the pandemic. Therefore, the banking industry is well-positioned to absorb a modest increase in assessment rate schedules of 2 basis points. In conclusion, it is staff's view that the final rule appropriately balances several considerations, including the goal of reaching the statutory minimum reserve ratio reasonably promptly, strengthening the fund to reduce the risk that the FDIC would need to consider a potentially pro-cyclical assessment increase in the event of a future downturn or industry stress before the statutory deadline, at a time when the banking industry is better positioned to absorb a modest increase in assessment rate schedules, and improving the timeline for achieving a 2% designated reserve ratio to strengthen the fund to withstand potential future banking crises. Staff recommend that the board approve and authorize publication of the final rule to increase deposit insurance assessment rate schedules by 2 basis points beginning the first quarterly assessment period of 2023. Thank you for your time, and we are happy to answer any questions you may have.
Thank you, Ashley. That was very helpful. I have a brief statement, and then I'll turn to the other members of the board. The FDIC board is considering today a final rule to increase initial base deposit insurance assessment rate schedules by 2 basis points beginning in the first quarterly assessment period of 2023. As of June 30th, 2020, near the start of the pandemic, the reserve ratio of the deposit insurance fund fell below the statutory minimum of 1.35%. Just to be clear, the reserve ratio of the deposit insurance fund is the balance of the fund relative to total estimated insured deposits. As required by the Federal Deposit Insurance Act, the FDIC board adopted a restoration plan in September 2020 to restore the DIF to at least 1.35% by the statutory deadline of September 30th, 2028. That's 8 years after the implementation of the restoration plan. The original plan maintained the assessment rate schedules and required staff to update the analysis and projections for the DIF balance and reserve ratio at least semi-annually. 2 years later, at the June 2022 semi-annual update to the board, staff projected the reserve ratio was at risk of not reaching the 1.35% requirement by the statutory deadline. Consequently, the FDIC board adopted an amended restoration plan that incorporated an increase to the deposit insurance assessment rate schedules of 2 basis points to improve the likelihood that the reserve ratio would be restored to the minimum level by September 30, 2028, and concurrently approved a notice of proposed rulemaking to implement the increase. The FDIC received 171 comments on the proposed rule and carefully considered all comments in developing the rule before the board today. In addition, staff updated projections and analysis using data for the second quarter of 2022. The FDIC recognizes that there was a small decrease in insured deposits of 0.7% and positive growth in the DIF balance in the second quarter. However, the reserve ratio of 1.26% remains below 1.3%, where it was when the restoration plan was first established over 2 years ago. While insured deposit growth showed signs of possibly normalizing in the second quarter, aggregate insured deposit balances remain elevated relative to pre-pandemic levels. Even with possible signs of deposit growth normalizing, insured deposits increased 4.3% over the last year. This growth rate is faster than the assumed insured deposit growth rate used for the two different scenarios in the analysis supporting this final rule. Thus, significant risk remains that the reserve ratio may not reach 1.35% by the statutory deadline, absent an increase in assessment rates. The final rule, which adopts the proposal without change, increases the likelihood that the reserve ratio will reach the statutory minimum of 1.35% within the deadline set by statute and is consistent with the amended restoration plan. Importantly, it also decreases the likelihood that the FDIC would have to consider imposing higher, more pro-cyclical assessments before the deadline. Strengthening the DIF is important because the banking industry faces significant downside risks. Future economic and banking conditions remain uncertain due to high inflation, rising interest rates, slowing economic growth, and geopolitical uncertainty. Any of these uncertainties could present challenges and have longer-term effects on the condition and performance of the economy and the banking industry. It is better to take prudent but modest action earlier in the statutory 8-year period to reach the minimum reserve ratio than to delay and potentially have to consider a pro-cyclical assessment increase. For example, in the event that the industry experiences a downturn before the FDIC has exited its current restoration plan, the FDIC might have to consider even larger assessment increases to meet the statutory requirement in a more compressed time frame and under less favorable conditions. We can recall the experience in 2008 and the need for a large increase in assessments during a time of severe economic and financial stress. However, if the FDIC exits its current restoration plan by reaching the 1.35% statutory minimum, and a later downturn in the industry results in the need for a new restoration plan, the FDIC would then have an additional 8 years to restore the reserve ratio to 1.35%, providing greater flexibility in setting assessment rates at a time of industry stress. The increase to assessment rate schedules also supports growth in the DIF in progressing toward the designated reserve ratio. This long-term goal is designed to increase the likelihood that the deposit insurance fund will remain positive throughout periods of significant losses due to bank failures and to reduce the risk that the FDIC might need to consider a pro-cyclical assessment rate increase. Given the economic uncertainties and the difficulty in projecting insured deposit growth and other factors that may affect the reserve ratio, under the final rule, the FDIC board will retain the flexibility to adjust assessment rates without further notice and comment rulemaking, provided the board cannot increase or decrease rates from one quarter to the next by more than 2 basis points. Maintaining the ability to adjust rates within limits should allow the FDIC to act expeditiously if warranted based on changing conditions. Overall, the banking industry continues to report strong earnings and is well positioned to absorb this modest increase in assessment rates. The increase in assessment rates is projected to have an insignificant effect on institutions' capital levels, is estimated to reduce income slightly by an annual average of 1.2%, and should not impact lending or credit availability in any meaningful way. I am therefore supportive of this final rule. The increased assessment revenue will strengthen the DIF at a time of significant downside risk to the economy and financial system, increasing the likelihood that the reserve ratio will reach the statutory minimum of 1.35% by the statutory deadline, while reducing the likelihood of a pro-cyclical increase in the future and promoting public confidence in federal deposit insurance. Under this final rule, the increase in assessment rate schedules will begin the first quarterly assessment period of 2023, and the first payment date will be June 30th, 2023, providing adequate time for institutions to prepare and plan for the increase. Finally, I would like to thank staff for their very thoughtful and careful work on this final rule. That concludes my statement. Thank you all. Director Sue.
Thank you, Acting Chairman Grunberg. So I support staff's recommendation to approve the final rule to increase the initial base deposit insurance assessment rate schedules by 2 basis points and to authorize publication of the final rule in the Federal Register. This increase in assessment rate schedules helps us meet our statutory obligation to ensure that the DIF reserve ratio will reach the statutory minimum of 1.35% by the statutory deadline of September 30th, 2028. 2 years ago, when the FDIC initially adopted the DIF restoration plan, the DIF reserve ratio was projected to increase and return to the statutory minimum without the need to increase the assessment rate schedules. Since then, however, the reserve ratio has fallen. Simply put, there's lost ground that needs to be made up. While insured deposit growth has shown signs of normalizing, aggregate balances remain significantly elevated. FDIC staff projections show that absent an increase in assessment rates, the reserve ratio is at risk of not reaching the statutory minimum of 1.35% by the statutory deadline. Now is the time for a modest rate increase while the banking industry is strong and profitable. This rate increase reflects prudent risk management and reduces the risk that the FDIC will need to take more dramatic and disruptive action in the future when the banking and economic conditions may be less favorable. For these reasons, I vote to approve staff's recommendation. I want to thank the staff for their excellent analysis and commitment to protecting depositors and supporting financial stability. Thank you.
Thank you, Mike. Director Chopra.
Well, thanks to everyone for all the back and forth and all the information you have provided us through the whole rulemaking process. I wanted to ask a couple questions just to make sure that we surface this for the record as well. The reserve ratio increased slightly since we proposed the premium increase at the June board meeting. So moved from 1.23% and up 3 basis points to 1.26%. This increase was largely driven by a decline in insured deposits in the second quarter. And I wonder if you could share if that's a typical experience for the second quarter. And I also hope you could discuss some of the projections that you've run using the latest data and the updated risk of missing the 2028 statutory deadline absent the proposed increase.
Sure. So first, yes, you're absolutely correct. Insured deposits declined by 0.7% in the second quarter. And that a decline in the second quarter is typical. We expect that to have such a decline. In fact, in reiterating Ashley's presentation, we've had a decline in second quarters for 6 out of the last 9 years. One of those quarters, one of the 3 quarters where we didn't have a decline was the second quarter of 2020 when we had significant fiscal stimulus from the CARES Act. Despite the second quarter decline, though, in growth, for the year ending June 30th, 2022, insured deposits had grown at a rate of 4.3% above our 2 scenarios, that rate of growth for our 2 scenarios. And so even the decline that we've had in insured deposits in the second quarter, the excess insured deposits resulting from the pandemic have not receded. and insured deposit levels are still significantly elevated, higher than they would be otherwise under normal growth that we would have expected since the pandemic. Under the first scenario, that assumes a 4% insured deposit growth rate, absent an increase in assessments. The reserve ratio doesn't reach the minimum until 2034. In our more favorable scenario, we have a 3.5% insured deposit growth rate, and absent a rate increase, we would reach the statutory minimum by the fourth quarter of 2026, but that leaves about 4 years between now and then, should we have a downturn. And if we do have a downturn, provides us little flexibility to avoid a more pro-cyclical, larger increase in assessment rates.
And is it fair to characterize those scenarios really not as doomsday scenarios? These are plausible scenarios based on our historical experience.
That's right. These are plausible scenarios based on reasonable scenarios based on our historical experience. And again, I would reiterate that we are experiencing a level of insured deposit growth higher than what we have in these scenarios.
And you didn't comment on this aspect, but could you say maybe a little bit about how you thought about the performance of the DIF and the securities portfolio?
Sure. So net investment contributions since the beginning of the pandemic have been negative or flat. And we have experienced unrealized losses has been a driver of that as interest rates have risen. However, that being said, we do expect to experience some growth in the DIF. We expect to benefit from some yield going forward, but that's uncertain. The timing of that is uncertain.
Okay. I wonder if you could share a little bit about not just the statutory minimum floor, but the board's requirement to meet a designated reserve ratio. So the rate increase would help us meet the statutory floor, but also put us on some sort of pathway to hitting the long-term target of 2%. I wonder if you could share more about the board's selection of the 2% target year after year after year, and how you came up with that when recommending to the board that it be selected at 2%.
Do you want to do this one, Ashley?
So the 2% designated reserve ratio was put in place in 2010 for the 2011 year following the global financial crisis. That's part of a long-term, comprehensive management plan for the DIF that was developed using historical fund losses and income data through 2 crises. And as part of that analysis in supporting the 2%, staff had found that the deposit insurance fund reserve ratio would have had to exceed 2% before the onset of both the crisis of the late 1980s and 1990s, as well as the global financial crisis, in order to maintain a positive DIF balance and stable assessment rates. So that 2% has been reaffirmed by the board every year since then. It supports a fund that would be sufficiently large as a precondition to maintaining a positive fund balance, so not going negative during a banking crisis, and also at the same time allowing for steady assessment rates and not having a procyclical increase.
I appreciate that. And I would also just say my own understanding is that the 2% was selected, as you said, based on historical losses, but there was some very close call big losses that were avoided. And I think if those losses did incur, we would expect that the target would be even higher. And we all know there were some very close calls that could have been very, very costly to the fund. So I appreciate all the work. I will enter a statement for the record. I'll just make one other comment, which is that I support all the work you've done on this and I'll vote in favor. But I think over the course of the rulemaking process, we did receive some valuable input, which made clear to me that we should really think about a longer-term policy about how we're setting deposit insurance assessment rates. I think first, we must work to find additional ways for the banks posing the most risk to the deposit insurance fund to pay more relative to the smaller institutions where the likelihood of large losses to the fund are tiny, given ease of resolution and other factors. And second, we must take steps to build a framework that ensure changes in assessment rates are more countercyclical. As I noted in my past statement, when we proposed the rule, we should adjust premiums upward and downward, ideally based on quantitative factors like economic conditions, recent industry profits, and other indicators. Third, we should try to develop a framework that relies a little bit less on ad hoc adjustments and more on a systematized formula based on some of those factors I mentioned earlier. And just as many laws provide for automatic adjustments based on inflation or other indicia, we should try over time to move in this direction to improve reliability of the board acting prudently, as well as to be transparent about how it will work. So, of course, none of our insured banks want to pay higher premiums. None of us ever want to pay higher premiums on insurance. I get that. But I think failing to take this step could be a gamble and risks violating the law governing the fund. And that said, I hope the board will continue to work with everyone to develop a more robust framework for the long term. Thank you very much.
Thank you, Rohit. There are no further comments from the board. May I have a motion to approve the final rule on assessments, revised deposit insurance assessment rates?
So moved.
And a second?
Second.
Thank you. All in favor, please say aye.
Aye.
Aye. The motion is adopted. Thank you very much to the staff.
Thank you very much.
Very helpful. The second item on the discussion agenda this morning is the advance notice of proposed rulemaking entitled Resolution-Related Requirements for Large Banking Organizations. Penn Stark and Ryan Tetrick will present the case.
Good morning, Chairman Grunberg and other members of the board. Staff is presenting for approval of the FDIC Board of Directors an advance notice of proposed rulemaking entitled Resolution-Related Resource Requirements for Large Banking Organizations. This notice is to be issued jointly by the FDIC and the Board of Governors of the Federal Reserve System and was approved by the FRB by a notational vote on October 14th, 2022. The ANPR would seek public feedback for 60 days on various aspects related to the concept of imposing a requirement that long-term debt be maintained by large banking organizations to enhance the resolvability of these institutions. The agencies and resolution authorities around the world have long acknowledged the importance of long-term debt as gone concern loss-absorbing capacity in the resolution of large, complex banking organizations. In the U.S., this led to the adoption of a regulatory requirement that our globally systemically important banking organizations, or GSIBs, maintain minimum amounts of total loss-absorbing capacity and long-term debt at the top-tier U.S. holding company. The structure of this debt, combined with pre-positioning of resources at material subsidiaries, was designed to support a single point of entry resolution, and improve resolvability in bankruptcy, and if necessary, under Title II of the Dodd-Frank Act. There is not a similar requirement for the maintenance of effective gone concern resources, such as long-term debt, to be maintained at a large bank that is subject to resolution under the Federal Deposit Insurance Act, or FDIA. Meanwhile, these non-GSIB large banks continue to grow in size and complexity and continue to increase their reliance on uninsured deposits as a source of funding increasing the potential impact of failure and elevating the challenges to an orderly resolution. There are more big banks than there were during the global financial crisis, and the largest banks are bigger and more complex. Among the banks that are not subsidiaries of US GSIBs, at year-end 2008, there were 14 insured depository institutions over $100 billion in total assets, while today that number has almost doubled to 26. The number of such IDIs over $250 billion has more than doubled from 2 to 6 banks in the same period. And the size of the banks in those ranges has grown as well, with the result that today the total assets for non-GSIB US IDIs over $100 billion is over $6 trillion, compared to $2.6 trillion at year in 2008. And the total assets of IDIs over $250 billion in that same category is over $2.8 trillion, compared to less than $900 billion in 2008. These banks as a group have a deposit profile with well over 40% of uninsured deposits. And for quite a few of these banks, the uninsured portion is well over 50%. So for the vast majority of bank resolutions, the FDIC pursues a strategy of selling a failed bank to another insured depository institution, as that has been the course of action which is least costly to the deposit insurance fund and least disruptive to local communities and to the financial system. But during the global financial crisis, there were limited and undesirable options available to the FDIC for resolving the largest failed IDIs, including disruptive and costly liquidation strategies or the sale of large banks to even larger financial institutions. The costs of these bank failures were significant, depleting the resources of the FDIC's deposit insurance fund. Yet during this period, the FDIC was able to resolve the failed Washington Mutual Bank, the largest failure for which the FDIC has ever been responsible, with little impact on the DIF, which would not have been possible without the significant stock of long-term debt outstanding at Washington Mutual at the time. This was $13.8 billion, or 4.5% of total assets. The challenges associated with the acquisition of a large failed IDI continue to be significant, both operationally and financially. And as a result, the universe of potential acquirers is extremely limited. Among other strategies, the availability of sufficient loss-absorbing resources at the depository institution enables the FDIC to preserve franchise value and support the possibility of a bridge insured depository institution as an option that would allow for the stabilization of the bank and for a range of options for the subsequent disposition of the bank in whole or in parts over time. So I'll now turn to the content of the ANPR. The goal of the ANPR is to explore how a long-term debt requirement can enhance the FDIC's options to resolve large banks in a manner that reduces the risk of a disorderly resolution and the outsized potential impacts on the deposit insurance fund. Among some of the questions in the ANPR, we are asking for public input on these key areas. How would long-term debt improve resolution options for large banking organizations, and how should it be structured? We're asking this question because while debt positioned at the IDI itself would support a resolution of the bank under the Federal Deposit Insurance Act, there are several possible structures that would improve resolvability, including that the debt be issued directly by the IDI to the market or by the holding company with a subsequent downstreaming of proceeds in exchange for debt at the IDI. Also, expectations regarding the plain vanilla nature of long-term debt included in the current FRB rule applicable to GSIB holding companies may be useful in a large bank context, and we are seeking feedback as to whether these other or fewer restrictions make sense for long-term debt at the bank. The ANPR also asks what alternative approaches should be considered for determining the appropriate scope of application of a long-term debt requirement to the population of large banking organizations. The ANPR is primarily focused on Category 2 and 3 banks identified under the 2019 Federal Reserve's tailoring rulemaking. That is generally banking organizations over $250 billion in total assets. But the ANPR also asks what other factors than size should be considered. For example, significant non-bank operations, critical services outside the bank chain, cross-border operations, or the extent of reliance on uninsured deposits. These factors could increase the cost, orderliness, and impact of a large bank resolution, particularly without the support of going concern resources to increase the options in resolution, and especially during a crisis where the practical and market limitations for selling large banks may be heightened. In addition, an additional question with respect to the scope of covered IDIs that we are asking is how these requirements could be coordinated with existing long-term debt requirements with respect to certain foreign banking organizations into GSIBs in a manner that's fair and effective. Finally, the ANPR asks what other requirements should be considered in conjunction with the long-term debt requirement. For instance, a clean holding company requirement would be helpful if the debt were issued at the parent and downstream to the bank. A governance mechanism or trigger framework, as has been developed through GSIB Title I resolution plans, might be helpful for the purpose of bankruptcy resolution planning. And other requirements with respect to separability options might improve optionality in resolution and in recovery. Public comment on these and other questions, including the costs and burdens of such a requirement, would provide the agencies with additional information to fashion an appropriate, thoughtful rulemaking with respect to long-term debt upon direction of the board. Accordingly, staff recommends the adoption of the proposed resolution and the publication of the ANPR in the Federal Register with a 60-day comment period. We're happy to take any questions you might have.
Great, thank you, Ryan. That was very helpful. I have a statement, and then I'll turn to the other members of the board. Today, the FDIC Board is considering an advance notice of proposed rulemaking, which would be issued jointly with the Board of Governors of the Federal Reserve System to seek public feedback on steps the agencies can take to improve the prospects for the orderly resolution of large banks in the United States. In response to the global financial crisis of 2008, the FDIC and the Federal Reserve have promulgated rules and guidance, both jointly and individually, to support the orderly resolution of large banking organizations. Many of these actions focused on the global systemically important banks, or GSIBs, including the requirement that U.S. top-tier bank holding companies maintain outstanding minimum loss-absorbing resources on a gone concern or closed basis in resolution, and meet certain other requirements, such as the establishment of a clean holding company. However, there are currently no comparable requirements for large non-GSIB banks, which pose significant resolution challenges to the FDIC. These challenges are distinct from those posed by GSIBs and from smaller community banks as well, where the purchase and assumption transaction by another institution is in most cases a practicable and least costly option. These large banks continue to grow, both through organic growth and through mergers and acquisitions. In addition, most of these banks have increased their reliance on large uninsured deposits to fund their operations over the past decade, with uninsured deposits often exceeding 40% of total deposits. While the activities of these banks are concentrated in traditional banking activities, certain of these banks have other significant complexities that add to the challenge of resolving the insured bank under the Federal Deposit Insurance Act, including material operations, assets, liabilities, and services outside the bank chain. These complicating factors can pose challenges due to the potential for discontinuity of operations and the destruction of value. The complexities, as well as the sheer size of these banks, present challenges to the orderly resolution of these large banks under the Federal Deposit Insurance Act and increase the potential impact of a possibly costly resolution. In general, the FDIC's options for the resolution of these large banks are limited. Approximately 95% of the resolutions conducted by the FDIC since 2007 involve purchase and assumption transactions, generally involving a single acquirer assuming nearly all of the failing bank's liabilities. This resolution approach, particularly applicable to community banks, has generally been the least costly, the least disruptive to depositors in the local community, and the easiest for the FDIC to execute. However, the size of large banks, by definition, limits the universe of banks with the capacity to acquire them if they fail. Even the acquisition of a $50 or $100 billion institution is a significant challenge, both operationally and financially, while only a limited number of the largest institutions, particularly GSIBs, would have the capability to acquire these large banks. Thus, while the ANPR generally focuses on the domestic institutions above $250 billion in total group assets, it contains questions about alternative approaches to scope and how and whether any new requirements should be applied to the U.S. subsidiaries of foreign banking organizations. It is clear that the FDIC must have other options for the orderly resolution of these large institutions in a way that minimizes the destruction of value, addresses the impact on depositors and local communities, maintains U.S. financial stability, and minimizes the cost to the Deposit Insurance Fund. One such option is the formation of a bridge bank, which can be established to take over the operations of the failed institution to allow time for restructuring and marketing the institution, but only if that approach can preserve the franchise value of the failed institution sufficient to make that approach less costly to the Deposit Insurance Fund than liquidation of the bank and payoff of the insured depositors. The challenges posed by a large bank failure are illustrated by two examples from the financial crisis: Washington Mutual Bank and IndyMac Bank. In the case of IndyMac, we saw how the lack of non-deposit liabilities, such as long-term debt, can have an outsized impact on the Deposit Insurance Fund. The failure of the $30 billion thrift institution in 2008 resulted in losses to the Deposit Insurance Fund of about $12 billion. That was 40% of the asset size of the institution. In contrast, the failure of Washington Mutual Bank, with $300 billion in assets, also in 2008, and the largest resolution ever undertaken by the FDIC, resulted in minimal costs to the Deposit Insurance Fund. This is due in large part to the fact that WAMU had significant long-term debt outstanding at the time of failure, approximately 4.5% of total bank assets, which was available to absorb losses in resolution. While in the case of WAMU, there was also an acquirer available with the capacity to assume all the deposits of the bank and in a position to close quickly, we know that that is not always an option. Gone concern resources at the insured depository institution potentially can improve the FDIC's options to complete an orderly resolution of a large bank under the Federal Deposit Insurance Act by increasing the likelihood that a transfer to a bridge depository institution to preserve franchise value would be less costly to the Deposit Insurance Fund and less disruptive to the financial system and local communities than a liquidation of the insured institution and a payout of insured deposits. Accordingly, the FDIC and the Federal Reserve are considering whether additional measures are warranted to increase the optionality for an orderly resolution of a large bank. This includes whether a layer of loss-absorbing debt held at the bank would be effective in supporting options to resolve large insured depository institutions across a range of scenarios, in a manner that is least costly to the deposit insurance fund while minimizing contagion risk and impact to the financial system and local communities. In particular, we would like to consider how to expand the options for resolution without resorting to the sale of the failed institution to another large banking organization or GSIB. In this ANPR, the agencies will explore the effectiveness of a long-term debt requirement in promoting optionality and orderly resolution. The agencies are seeking input on questions such as how the debt, which could be held at the bank, should be structured and issued, what's the right approach to determining the institutions in scope for such a requirement, what is the right calibration of the amount of any such requirement, and what other requirements should be considered. The agencies also seek to gain a better understanding of how the different alternatives being considered might impact the cost or burden of such requirements. This is the first step in developing an approach in conjunction with the Federal Reserve to address the risks associated with the resolution of large banks, including the risks to the deposit insurance fund, to the customers and counterparties of the banks, to local communities, and to the safety and soundness and stability of the banking system. I am pleased to support this advance notice of proposed rulemaking. And finally, in particular, I would like to thank the FDIC staff, as well as their colleagues at the Federal Reserve, for their thoughtful and important work on this significant issue. I look forward to receiving the comments we receive. That concludes my remarks. Director Sue.
Thank you. I too support the FDIC's joint issuance with the Fed of this ANPR on resolution related resource requirements for large banking organizations. The time is right for this ANPR. As I noted in my remarks that I gave at the Wharton School in April of this year, the growth of large U.S. banking organizations warrants our attention. The number, size, and complexity of large banks, especially non-GSIBs, have increased materially over the years. Reevaluating the resolvability risks and requirements for these firms will help mitigate the risk of a new class of too big to fail firms from emerging. At the same time, it's critical that our actions as regulators promote competition. The same firms that led the banking industry or the banking system in terms of size over a decade ago continue to lead the banking system today, raising questions about the competitiveness at the largest banks. This joint ANPR represents a concrete step towards addressing the twin imperatives of financial stability and competition, exploring the development of a rule that can ensure the resolvability of large, domestically systemic banks will promote financial stability by guarding against the rise of non-GSIBs that may become too big to fail, while enabling true competition amongst the largest banks. Regulators should not be forced to choose between financial stability and competition. We need to find a way to achieve both. This ANPR puts us on that path. The ANPR also complements longstanding work by the Basel Committee on Banking Supervision with regard to domestic systemically important banks, or DSIBs. For these reasons, I strongly support the ANPR and look forward to the public feedback on it. Thank you.
Thank you, Mike. Director Chopra.
Let me just follow up on the comments you both have made before I ask a couple questions. I think I'd be remiss if I didn't recognize that we're actually 3 years this week to almost to the day where you really outlined, I believe at Brookings, a concerns about this. And I think the case studies of WAMU and IndyMac are often thought about in the context of how absentee consumer protection has systemic impacts and real serious risks. But I think there was also this question of resolvability of a large institution. And I would note, IndyMac was not actually over $100 billion in assets. It was smaller than that, I believe, and still posed an enormous consequence to the fund. So I would also share, just to underline a point the acting chairman said, in the case of Washington Mutual, regulators got lucky that there was an acquirer who had already done due diligence before there was a run. And often that due diligence takes a lot of time, takes a lot of energy. And in some ways, if that had not happened, it's hard to know where we would be in terms of how that resolution would have taken place and the potential costs of it. So I would continue for us to not, I'm glad we're learning from that and we're drawing about all the lessons. On this question of due diligence, where there was not due diligence was after some of these these sales that were made to larger banking organizations. The regulators did not really go through its normal process when evaluating a bank merger application or other issues that would normally be done absent a crisis. And I think that we underappreciate that harm that occurred. So let me just ask the staff a couple questions. First, thank you for all the work you've been doing with the Fed on this. You all have really been sound leaders on all of this, and I would note that it's really important that we all clearly understand what the acting chairman and you have said about purchase and assumption resolutions typically being least cost, how that's often an option to us in a much smaller institution. So I think, as you said, purchase and assumption is typically preferred for a whole host of reasons. It's been used in, I believe, 95% of failures from 2008 to 2013. But in the case of one of these firms that is a DSIB, could you describe realistically the universe of potential acquirers for them if it failed?
So I'll start. So there's very few. I mean, just strictly in the abstract, thinking in terms of capacity, in terms of the capital resources, other financial resources, and operational challenges, the only potential acquirers that are relatively likely to have the capacity are GSIBs. Putting aside whether that's desirable, domestic GSIBs and maybe foreign GSIBs potentially in the abstract could have the capacity to. There's a whole host of challenges that come with that, including some formal barriers in terms of limits on concentration of deposits and financial sector liabilities, as well as what that would mean in terms of the further concentration of systemic risk. But in the abstract, conceivable. A merger of equals is conceivable, but even if you look at all of the IDIs over 100 billion, that population is very, very small. And by the time a large bank is failing, the attractiveness of that institution is significantly reduced. There needs to be an acquirer available at the time that has the right financial capacity, synergies with its business model, and just able to consummate an acquisition in a short period of time to make that possible. So when we think about resolution planning for these institutions, we don't think of a sale as part of our day-to-day planning as it is for smaller institutions, because we know that there's a very strong likelihood that, particularly in the context of a failing bank and perhaps a wider economic downturn, if that's occurring at the time, we can't rely on there being an acquirer available. It's very unlikely. And so that's less of a plan than it is a possibility, but just very, very few institutions.
Yeah, I would just comment here that the options of failure of a very large retail bank, it also has a huge impact on true retail depositors who will have real confusion as to what would happen, because we're not accustomed to large banks like that failing, as well as ongoing small business relationships and credit and a whole host of attendant issues. if it was if there's a sale then that goes to a GSIB, I think experience has shown from the CFPB's supervision that there are ongoing disruptions to consumers through systems integration, IT architecture, and true operational issues. So in some ways, neither of these are really all that attractive in terms of options. We spend a lot of time focusing on the largest Wall Street banks or GSIBs, and that makes sense given their size, scale, scope, and complexity. But, as the controller mentioned, some of this other tier is also growing in size and complexity. Could you put the size and importance of these DSIBs in context relative to the broader financial system?
So compared to GSIBs, they're relatively smaller. They have fewer critical operations, although some of the institutions in this tier do have formally identified critical operations. And they score lower on the formal measures of global systemic risk that are put forward by the Federal Reserve or by the Financial Stability Board. That said, just looking at the size of the largest banks today, they're comparable in size to the largest financial institutions that failed during the crisis. Bear Stearns was about $400 billion. We have 6 banks over that size now. Lehman Brothers was about $640 billion. They're growing to approach that size. Those institutions had assets, liabilities, operations spread across multiple jurisdictions, significantly spread across multiple jurisdictions, and we're more focused on trading, capital markets, investment banking type activity. And so we're more integrated into the global financial system. But the domestic banks are highly concentrated in the U.S. The vast majority of their assets tend to be in the U.S. and focused on traditional banking activity. And so their failure would likely have a more concentrated impact on traditional U.S. banking activity and in the communities in which their operations are concentrated.
And probably huge regions of the country, too, where their footprint is most concentrated. I'll just say that on this point, while we should all recognize they are smaller than GSIBs, they are not small. So, we have some guidance in our statute about what is considered large. Sometimes that's defined as 10 billion. We have banks over $1 trillion in assets now. Even though they are smaller does not mean small. And I think it's important that we recognize that. I just have a brief statement, which I'll enter for the record. And I'll try not to repeat too many points that the chairman and the controller have shared. But today, we're taking an important step to reduce bailout risk among a group of systemically important financial institutions and guard against increasing concentration creep in banking. In conjunction with the Fed, we're issuing an ANPR to help prepare for a potential failure of a very large bank that isn't one of the biggest Wall Street banks. Here's the pickle that we're in. The U.S. now has a substantial number of these massive banks with over $100 billion in assets. These aren't the very biggest ones that are deeply integrated to the global financial system, as you mentioned, like JP Morgan Chase and Citigroup. These are domestic, systemically important banks that are heavily focused on retail and commercial banking. They've grown much larger over time, given that the Justice Department and the bank regulators have been relatively strict when reviewing small bank mergers and quite lax when evaluating big ones. If one of these DSIBs were to fail, we would be in trouble. Avoiding a severe disruption to households, small businesses, and the broader economy could require a bailout or a government-facilitated sale to an even larger bank. The sales of Wachovia to Wells Fargo and WAMU to JPMC help the FDIC avoid enormous losses to the Deposit Insurance Fund, but also increase the concentration of banks that were already too big to fail. Our notice seeks input on whether a DSIB needs to have a funding structure that gives the FDIC more options to deal with its failure beyond just selling it to a much larger bank. I fully support the issuance of this notice and just want to offer a few cautionary notes. First, If we do pursue rulemaking in this area, this should not serve as a rationale for continuing the lax and opaque merger review process of the past. I fear that merger applicants might point to enhanced resolvability upon failure as the basis for allowing very large mergers to proceed without a rigorous analysis grounded in fact and law. I look forward to the FDIC updating its Bank Merger Act policy statement to address some of these challenges and reflect current practice. Second, our effort to reduce the risk of bailouts or increase concentration upon the failure of a DSIB should be complemented by efforts to reduce the probability of their failure in the first place. One of the best ways to limit the harms associated with large bank failures is to stop them from happening. And we should continue our work to better utilize our existing tools to accomplish this, particularly given some of the loosening of requirements in recent years. Third, our increased attention on DSIB should not be interpreted to mean that it is mission accomplished when it comes to the very largest GSIBs. If one of these institutions runs into trouble, there is still a big risk that it will create chaos that requires taxpayer support or a backdoor bailout. So the work on this front is not over. Thank you again for all of the work that you and the team have done on this, along with the Fed. We'll look forward to reviewing the comments and move expeditiously on a determination whether to propose a rule, hopefully in the near future. Thank you.
Good. Thank you, Rohit. If there are no further comments, may I have a motion to approve the advance notice of proposed rulemaking entitled Resolution-Related Requirements for Large Banking Organizations?
So moved.
May I have a second?
Second.
Thank you. All in favor, please say aye.
Aye.
Aye. The motion is adopted.
Thank you.
Ryan, Penn, thank you very much. The third and final item on today's discussion agenda are proposed amendments to the guidelines for appeals of material supervisory determinations. Sheikha Kapoor and James Watts will present the case.
Good morning, Acting Chairman Grunberg and members of the board. In this case, staff is presenting a notice and request for comment on proposed amendments to the FDIC's guidelines for appeals of material supervisory determinations. As background, Section 309A of the Regal Community Development and Regulatory Improvement Act of 1994 required each of the federal banking agencies to establish an independent intra-agency appellate process to review material supervisory determinations such as examination ratings. To satisfy this requirement, the FDIC's board established the Supervision Appeals Review Committee, or SARC, and adopted guidelines for appeals of material supervisory determinations that govern the appellate process. Since first establishing the SARC in 1995, the board has periodically amended the guidelines to make changes to the process. In January 2021, the FDIC replaced the SARC with a standalone office within the FDIC, known as the Office of Supervisory Appeals. Earlier this year, the board voted to restore the SARC structure as the final level of review of material supervisory determinations. At that time, the FDIC also requested comment on the amended guidelines, including in particular the Ombudsman's role in the supervisory appeals process. The comment period closed on June 21st, 2022, and the FDIC received 4 comment letters. Commenters raised concerns with the restoration of the SARC structure, with one commenter stating that the process should reflect a balance of perspectives and will be less independent if the board has control over the outcome. A commenter also raised concerns about the information shared with banks that have submitted appeals and recommended that the FDIC stay supervisory actions while an appeal is pending. Commenters generally supported expanding the Ombudsman's role in the appeals process, suggesting that the Ombudsman's experience in resolving disputes between banks and regulators would benefit the process. I will now turn it over to James Watts to discuss the proposed guidelines in more detail.
Thanks. The proposed guidelines would retain the SARC as the final level of review for material supervisory determinations. To address the concerns regarding the need for a balance of perspectives to be reflected in the process, the Ombudsman would be added to the SARC as a non-voting member. Serving as a non-voting member would minimize any potential for conflict with the Ombudsman's role as a neutral liaison between the agency and supervised institutions. As a non-voting member, the Ombudsman would be expected to attend SARC meetings, participate in discussions, and offer views, opinions, and advice to the SARC during its deliberations, based on the Ombudsman's perspective as a neutral advocate for a fair process and as a party independent of the supervisory process. Some commenters had expressed concern about possible retaliatory actions if an institution submits a supervisory appeal. To alleviate these concerns, under the proposal, the Ombudsman would monitor the supervisory process following the submission of an appeal and would be expected to report to the board on these matters periodically. A few commenters also expressed concern about the elimination of a provision that generally required communications between the Office of Supervisory Appeals and supervisory staff to be shared with the appealing institution. There's value in ensuring that both parties to the appeal are aware of the information considered by the decision maker, and the proposal would require that all materials considered by the SARC are shared with both parties to the appeal, subject to applicable legal limitations on disclosure. The Ombudsman would oversee this aspect of the process. Finally, the proposal would amend the guidelines to allow an institution to request a stay of a supervisory action or determination from the appropriate division director while its appeal is pending. The division director would have discretion to grant a stay and could grant a stay subject to certain conditions where appropriate. If approved by the board, the notice would request comment with a comment period of 30 days. This concludes our presentation on the proposed guidelines, and we would be happy to answer any questions you might have.
Thank you, James and Sheikha. I have a brief statement, and then I'll turn to other members of the board. The FDIC Board is considering today a notice and request for comment on proposed amendments to the guidelines for appeals of material supervisory determinations. The Regal Community Development and Regulatory Improvement Act of 1994, known as the Regal Act, required the FDIC, as well as the other federal banking agencies, to establish an independent intra-agency appellate process for the review of material supervisory determinations. The term independent appellate review process under the statute means a review by an agency official who does not directly or indirectly report to the agency official who made the material supervisory determination under review. In 1995, the FDIC's Board of Directors adopted guidelines for appeals of material supervisory determinations to satisfy this mandate. Under the guidelines, the FDIC's longstanding practice has been to ensure review of material supervisory determinations by a board-level committee known as the Supervision Appeals Review Committee, or SARC. In 2021, the FDIC created an Office of Supervisory Appeals to replace the SARC in the appellate process. The creation of this office allowed for reliance on individuals with previous supervisory experience recruited from outside the FDIC and hired for intermittent service on a time-limited contract basis to make final supervisory decisions on behalf of the FDIC. This represented a significant departure from the FDIC's established approach for over 25 years of reliance on a board-level committee. Hiring individuals on a part-time, time-limited service, on term-limited basis to serve in such a role also represented a fundamentally different approach to how the other financial regulators have carried out their responsibilities under the Regal Act. While there is some diversity of approach among the Board of Governors of the Federal Reserve, the Office of the Comptroller of the Currency, and the National Credit Union Administration, all of these agencies utilize full-time internal staff or board members to carry out their appeals processes. Earlier this year, the FDIC Board voted to restore the SARC structure as the final level of review of material supervisory determinations. This action ensures that the FDIC's Board of Directors, which is vested with responsibility for the agency's supervisory functions, remains accountable for material supervisory determinations. In addition, a review of material supervisory determinations by a board-level committee promotes independence from the usual supervisory or examination channels in a manner consistent with the Regal Act. While the revised guidelines were effective immediately, the FDIC specifically requested comments on the guidelines, including the Ombudsman's role in the supervisory appeals process. The proposal being considered by the FDIC Board today would enhance the appeals process by expanding the role of the Ombudsman as recommended by commenters. It would also address comments concerning the sharing of materials with appealing institutions and allowing institutions to request a stay of a supervisory determination while an appeal is pending. Under the proposal, the Ombudsman would be added as a non-voting member of the SARC. The Ombudsman also would be required to monitor the supervisory process following an appeal, which may alleviate some institutions' concerns regarding potential retaliation. Further, the FDIC Division Directors for Risk Management Supervision and Depositor and Consumer Protection would also have discretion to grant a stay of a supervisory determination while an appeal is pending. Today's notice includes a further request for comment on these proposed changes. I believe these are significant enhancements that respond to issues raised by the commenters and look forward to receiving additional comment. So in conclusion, this notice of proposed guidelines is an important step to improving and clarifying the supervisory appeals process. I'd like to thank the FDIC staff for their thoughtful work in bringing this notice to the board today, and I'm pleased to support this notice. That concludes my comments. Director Sue.
Thanks, Acting Chairman Grunberg. So I too support the staff's recommendation to adopt the proposed amendments. The proposed amendments before the board today respond to the comments received and make several important changes to the guidelines. First, it adds the FDIC's ombudsman to the SARC as a non-voting member. Adding the ombudsman as a non-voting member provides an additional independent perspective while preserving the role's longstanding commitment to neutrality. Second, to alleviate concerns about potential retaliation if an institution submits a supervisory appeal, the proposal will require the ombudsman to monitor the supervisory process following the submission and to report to the board on these matters. Both of these proposed amendments are consistent with the importance of the role that ombudsmen play. Third, the proposal increases transparency by adding a requirement that all materials considered by the SARC are shared with both parties to the appeal, subject to applicable legal limitations on disclosure. This transparency helps to assure that both parties are aware of the information shared with the decision maker and have an opportunity to respond to the information. For these reasons, I support adoption of the proposed amendments and approve publication of the amendments for notice and comment. This same open and transparent process directly led to today's proposed amendments, and I look forward to the public's comment on the proposal. Thank you.
Thank you, Mike. Director Chopra.
No, just wanted to share my thanks for all the work done on this. Nothing further to add.
Great, thank you. If there are no further comments from the board, may I have a motion to approve the proposed amendments to the guidelines for appeals of material supervisory determinations?
So moved.
May I have a second?
Second.
Thank you. All those in favor, please say aye.
Aye.
The motion is adopted. Thank you, Sheikha.
Thank you.
And James. There's no further business for today's open meeting. The business of this meeting is concluded, and we'll now adjourn the meeting. Thank you all very much, and we'll move into closed session.